The market's multiple lifetime highs. What ignited it, and can the momentum hold? The big, beautiful bill. Now that it's been more than a month, what's the early market impact, and what does it mean for our paychecks, our factories, and our portfolios? And Nvidia at $4 trillion, AI's center of gravity stock, and what concentrated leadership means for tech risk. Stay with us. It's the weekly update from CB3 Financial, and it starts now. Last week was a fireworks show for the bulls. Multiple lifetime highs across the major indices, a calmer volatility background, and a rally broadening beyond the usual suspects in technology. So let's look at the highlights, and I'll take you through the three big stories we'll unpack on the CB3 Live show this month, which is Thursday night. And finally, we'll take a look at second quarter earnings as we wind down earnings season. So last week's trading highlights: breadth and leadership. Tech certainly continued to lead, but participation widened into financials, energy, and with small caps showing better than relative strength. Dividend leaders kept grinding higher. That's the slower paced value stocks, and they're offering income plus defense while growth still sets the pace. The 10-year note drifted lower without any drama, and the VIX stayed subdued. So that's good. We want to see the VIX, the volatility index, under 16 to keep the markets calm, all right? The macro undercurrent continues to be tariff policy, and now the upcoming meeting between Trump and Vladimir Putin in Alaska later this week. So here are the three big stories that opened the show. Here's why we are where we are. We have easing financial prints in the data versus expectations, and that has relit risk appetite while the Fed stays patient. Trump and Jay Powell are still bickering. They're gonna bicker as long as both of them are breathing. But sooner or later, the Fed is going to relent and lower rates, or they're going to have more Fed governors resign. The rally has broadened, and that's what we want to see. You're seeing financials, you're seeing energy participate along with mega cap tech, which reduces fragility relative to a one-factor market. A one-factor market meaning just technology or just quantum or just AI stocks going forward. What could derail this? Stretched multiples. In other words, stocks that are priced too high in the pockets in tech. A policy headline that spikes inflation, obviously that would scare the Fed and make them hold off even longer on cutting rates, or an earnings season that guides cautiously. We're not seeing that so far. Thursday night on my show, I'll talk about what earnings looks like for the second quarter, and actually is a pleasant surprise. So here's how I think about this. We got to respect the uptrend, and that's why we are fully invested in all programs, but you have to watch for signs of fatigue. That's the real question here, signs of fatigue. We have new highs with fewer stocks this week, and that always raises a little caution. We want broad participation above and beyond the entire stock market. There are some momentum divergences on the major indices. In other words, the Dow has not been participating to the same degree as the NASDAQ and the S&P 500. So near term, the path of least resistance remains higher as long as earnings confirm and policy stays predictable. Right now, earnings are on track to be really strong for a summer quarter, second quarter, April, May, June. And of course, we're reporting it here in July and August. So that has been a surprise and a pleasant one. The second story is the big, beautiful bill. So obviously it's been out now. It was signed July 4th. Is it a stimulus or is it a spill? What's in focus right now is immediate expensing for factories through 2028, and that is having a real CapEx pull forward potential, meaning that construction, industrials, and onshoring companies are building up their inventories. They're adding on to their physical building structure, and that's a positive. Personal tax tweets, things like tips, overtime, senior deductions, aiming to nudge disposable income higher are working. And we're seeing upticks in that particular area of expenditures, and it is supportive for consumption at the margin, especially for value-conscious categories. Clean energy rollbacks complicate the outlook for renewables, but conventional power generators, meaning fossil fuel, and grid infrastructure themes may stay bid, which means they may stay strong as AI power demand headlines persist. Here's the reality. You are not going to power a $50 to $100 billion AI factory center with renewable energy. Not going to happen anytime soon. Ultimately, yes, not sure in this lifetime, but right now, carbon energy is what it takes to power these behemoths. So the manufacturing-friendly provisions support near-term growth, but longer-term deficit arithmetic and state-level costs keep the policy risk premium alive. This is a little bit of mumbo jumbo, but what I want you to be aware of is there's so many moving factors here. You have some really good earnings coming out. You have this geopolitical strife, as I mentioned earlier on the show, that Trump and Putin will be meeting in Alaska. He really wants to end this war. And certainly when bombs stop dropping in Ukraine, it's going to put the world a little bit more at ease, and that's a plus, as well as certainly not having people being killed. The number 3 story, Nvidia now at $4 trillion. Brilliance meets basic risk. Here's the giant truth. Nvidia's AI dominance is powering index-level returns and CapEx cycles from chips to data centers, software, and utilities. In other words, Nvidia is literally dragging the entire market up with it. All right. It has become the single most important stock in the world and, frankly, in history. So here's the reality on concentration risk. Truth. When one name, Nvidia, becomes an outsized slice of the S&P 500, portfolio outcomes get more sensitive to a single earnings data point, i.e. Nvidia's earnings. And that creates uncertainty and angst. So here's what we have to watch for. Supply chain cadence. All right. Is the AI demand beyond hyperscalers and any sign of margin normalization as competition responds? There will be people responding always to Nvidia and going after them. And we want that. It's not that we want Nvidia to be any less. We want all the rest of its competitors not to be left behind in the dust. So that's what we're cheering for. If you're cheering for the market, we want to see all of technology blossom. And then we certainly want all the other sectors to keep up with it too. So what we had last week that was big was the small caps improving, dividend stocks still holding their own, commodities still doing fine. Looking ahead to the second quarter earnings, we're wrapping those up. You'll see a full report Thursday night. Sector divergence, tech still leads, but watch consumer resilience, healthcare, and the industrial backlog quality also step up. So that's where we are heading into this Thursday night CB3 Live episode for August. The bulls control the tape into earnings. We're almost done with earnings now, and they have won the battle. But the market has raised the bar, so we're staying cautious, we're staying tactical, and let's let the numbers, not the noise, lead us as your portfolio manager. Thanks for listening. I'll dig deeper into all of this on the next show Thursday night. Stay with me. We will see you next week on the weekly market update and this Thursday night on CB3 Live. I'm CB3. We'll see you next time.